Hello, everyone, and welcome to Ancient Roman Trading Secrets with General Romulus. That's me, Romulus. This show is brought to you by Backpack Trader. Our goal is to help you become the best version of the backpack trader you can possibly become. Stick around, everybody, because we have got a heck of a show for you today. We are going back, not backpacking, but back in time. That's right, jumping into the time machine itself to reveal some ancient Roman trading secrets. So, grab a drink, put your feet up, take a break, come back in time with your old buddy Romulus. Here we go. We're going to talk about retracements. Retracements, the definition, look at that, Wordnik actually uses a definition relating directly to what we are going to discuss. It's a noun, everybody, a reversal in the trend of the price of a stock or a commodity, a reversal in the trend. Looking back, way back, as I mentioned, we're going into the time travel warp today. We have a chart in front of us of the yield of the U.S. 10-year. So this is what our federal government, the American federal government, pays when they're borrowing money over a 10-year period of time. There has been consistent borrowings from the American government on a 10-year time frame, generally speaking, going all the way back to 1792. Wow, all the way back. That's a little further than we're going back in our time machine today. The average yield, by the way, today, dating back to 1792, 7.2%. Less than half it is today. Wow, we still have a long way to go if we're going to retrace all that. But we're not talking about a retracement back to the 1792 average yield. We're talking about something a little bit different. Here is right before the COVID crash. So yields were coming down anyway before, okay? This is a weekly chart. So here we're coming into January, February of 2020. Yields were starting to pull back. Why? Because there were already politicians and other people that knew what was going on without breaking the news to the public. Those little scoundrels. Can you believe that politicians were keeping secrets from us to enrich themselves before they told us what to do? Come on now. That is never going to happen. Well, it did here. Anyway, so rates are coming back a little bit, and here right before the COVID crash starts right there, okay, right there. Then yields absolutely plummet as everyone in the world is flying to the safety of the U.S. government bond, considered by many the safest investment in the world, which when buying goes on, when there's demand for bonds, it pushes the yields lower and lower. Right here in March of 2020, that's the lowest yields have ever been in the American government history, down to under 35 basis points. They start to pull back up. Okay, what we have here, this is a bit of geometry. We love geometry over here at Club Romulus. So we have some geometry here, and this is called an ascending, as in things are ascending a mountain, ascending triangle. You see these points right here when the yields come back down. These points are getting higher and higher. This is called a series of higher lows, but it's capped out by a horizontal line, which is serving as a resistance area. So this is a very typical textbook ascending triangle. And over the course of the late period of 2021 and early 22, as rates were getting up to the higher portion of the horizontal line right there, rates are starting to break out. I started to write in my weekly reports that, hey, maybe the yields retrace all the way back to where they were right before COVID, which from up here isn't that far to go. It only has to go up here, okay? Well, that happened, and then rates kept getting a little bit further. And then I thought, well, wait a minute. If interest rates can fully retrace that entire move, why can't everything else? And I mean everything. I mean, even your hairstyle. Everything retraced back to where it was right before the COVID crash. Okay, so if you have a former spouse, get ready. They might be coming back into your life. Okay, so retracement in the bonds. There it is. That speculation of everything retracing back to where it was. And again, a retracement is a reversal in the trend of the price of a stock or a commodity. There we are. This fully retraced, then kept going and going and going. But before we kept going, I started writing and speculating about simply everything else returning to where it was right before the COVID crash. So let's take a look around. In the S&P 500, that would mean lower prices, as it was with every single equity asset out there. But here's the Russell 2000. Okay, Russell 2000 is a basket of the small cap stocks. As I'm writing this, we're talking about and speculating, we're talking about prices being way up here, okay, way up in these higher echelon areas. And I'm talking about prices coming back and fully retracing to where they were right before the COVID crash, which puts us right here. Well, look what happened. Whoa, check it out, everybody. The time machine has revealed its magic ancient Roman secrets. Lo and behold, just a few weeks ago, the Russell 2000 fully retraced the entire move back to where it was right before the COVID crash. Everything gone. Disappeared like ancient Roman dust in the Colosseum. The sands of the Colosseum just fading in the wind. That was the first one to go. Then I looked at the S&P 500. Right before COVID, that was at 3,400. So it had a long way to go and still has a long way to go. Hasn't gotten there. But look what else happened. The Dow Jones Industrial Average, the venerable, oldest, one of the original stock market indexes in the entire world. The first index was the Dow Jones Transportation Index. The second oldest index in the world is the Dow Jones Industrial Average, which is what I have up here right now. And look at that. It fully retraced. Full retracement in the mighty Dow Jones Industrial Average, everybody. There it is. This also happened a couple of weeks ago, 2 weeks ago to be exact. Full retracement in the Dow Jones. So we've got two of the major four indexes in the United States that have fully retraced their entire moves to putting them back to where they were right before the COVID crash. What about everything else? S&P 500 still has some way to go. As I mentioned, 3,400 is the number. NASDAQ also has a way to go. Right before the COVID crash, that was up right under 10,000. Right under 10,000, 98.38 is the high right there before the crash. And right now it's at 11,100. So it's got about 11.5% to go if it were to retrace fully back down to those levels. Another 11.5% after being down 30% or more from its all-time highs. Can you handle that? Well, everyone in Club Romulus handles it just fine because we've been short and banking, baby. I mean, banking. We're killing it this year. But everybody else I know is losing money. And I mean everybody, and I mean everybody. Everyone else is losing money except for people in Club Romulus. That's why you should join. And by the way, joining is simple. All you have to do, just click the link right there. Join Discord for free. That's right, for free. You can start checking out our work. Send me a note. Love to hear from you. Love to have you join us. There are a few other important issues that the time machine can reveal to us. Here you go, NASDAQ. I mean, this is important. This is where a lot of the retail trading community likes to get involved and hopefully get their fortunes made. Last time the NASDAQ closed below, and this is a weekly chart still, by the way. Last time the NASDAQ closed below the 200 weekly moving average was at the COVID lows right in there, okay, the middle, late March 2020. Stopped at it just a couple of weeks ago. Didn't close below it. Ooh, a 3-point miss. 3-point miss by not closing below it. Didn't close below it, but touched it right there. First time since the COVID crash low. Let's go back, though. We're in the time machine going a little further, not all the way to ancient Rome, but further back. See, we've covered many years. We're over 10 years right now, still going. And the last time it was below the 200-day week moving average with any kind of meaning was 2010. Kind of hummed and hawed around here. But really, the 08 crash, the financial crisis crash was the last time that happened. Okay, so we want to bring that up because look at the Russell 2000. Not only what is it the first one to fully retrace, and right now, even just a little bit lower as of this morning. But look, it didn't just stop at the 200-week moving average. It cracked right below it, rallied to it, and then failed. Failed, okay? Now, the Dow Jones still has some room above it. S&P still has some room above it. But I think the Russell 2000, once again, is serving as an excellent crystal ball, a reader of the tea leaves for us, and telling us what probably should be coming for the other major indexes some point in the next 3 months. Now, there's a lot talked about right now. Before we get into that, I have one thing that I really want to show you. Very important. My partner TJ is speaking in a week and a half at the Wealth 365 Summit online financial conference. There are roughly 25 to 30 excellent speakers. One of them is my original mentor, Ralph Atkimpora. So check that out, everybody. Sign up. Just click the link right there. Sign up and get yourself involved. It's a free summit. It goes on for a couple of days. Check out the speakers that you want to see. Make sure that you are in attendance there. I highly recommend that. All right, what we have here is a chart of the euro against the US dollar. As the chart points down, That means the euro is going weak against the US dollar. Okay, we have right here, this is a weekly, by the way. This looks like an inverted cup and handle, everybody. There's still some downward action that is needed to be resolved before the pattern is fully executed there. But if it is, there's about par on that one, okay? About par. If you don't know what that means, click the link below, join our Discord, and I'll explain it to you. Not time to do that today. But look at this. It's also flirting with support from way back in 2016, which it's very, very close to breaking that. And then look, I mean, do you see any other support for, I don't know, a decade or more after that? Anybody? Anybody? Bueller? Anybody? No, you don't. You don't. This is scary for Western European citizens. And look, I'm still going. Look at that. Next area of support dates back to 2002 and 3. That is frightening. The standard of living of the average Western European citizen over the next 12 to 18 months is about to deteriorate like crazy. The yen has also been getting clobbered against the dollar. The dollar is showing a lot of strength across the board with the higher interest rate environment that is being demonstrated, although not today, but over the last several months. And traders obviously believe that will somewhat continue for the next several months. Okay, hey, this has been your old buddy Romulus. I'm heading back to ancient Rome for some summer fun. I hope that's also in your cards. 4th of July weekend in the United States of America. Happy holiday, everybody. Enjoy, be safe. That's all for now.